Thank you very much. So the title of this stream is New Quant Methodology. And we have 4 segments in the stream. First is Emanuel Derman speaking on hedging tail risk for funds of hedge funds. And I think that this topic is very obviously today. Tail risk, given the binary nature of the markets, continues to be something that people are interested in and want to understand really how to approach that endeavor. Next we have Randy Saff from Genius, quantitative investing. And this really gets at social media and how he leverages social media in Next, we have Alexei Polishuk talking about overcoming quant modeling challenges from market conditions of high volatility, algo trading, and shifting liquidity patterns. And again, this is very topical because we are all dealing now in a market that is extraordinarily challenging from this perspective. A lot of things are shifting under our feet as we look at historical data sets. A lot of those don't give us the right kind of information that we want because the markets are often driven just by political decisions in Europe and by new players in the market and so forth. So from that perspective, that presentation I think is very interesting. And then we round out the day with a panel discussion, developing and managing low volatility strategies. These are 4 rather eclectic presentations, very different types of presentations. And to me, that speaks to really the benefit and importance of conferences like this that I think is really embodied in this stream. And that is the variety of presentations, the variety of quantitative methods, and the variety of mental models that the speakers in their own respective firms are applying to solving problems. We all come from different pockets in the financial industry, and we're all trying to solve particular problems that we're dealing with. And the beautiful thing about conferences like this, and again, I think embodied in this stream, is that we come to a conference and we get see a lot of different approaches that can then generate very creative ideas and ways that we can perhaps go back to our own respective pockets of the industry and apply that knowledge in a new and unique way. So with that, I will introduce our first speaker. So I actually first met Emanuel Derman about 10 years ago, and given his reputation, I had certain expectations in my head of the kind of person he would be. And what struck me is that as we talked about quantitative issues and different quantitative approaches, that he had a very qualitative perspective on these issues. Always thinking about when would the model work, when wouldn't the model work, what were the different components of the model that made sense or didn't make sense. And it was this kind of deep intuitive approach to thinking about mathematical models that I found really fascinating. And I think that it is this combination of both a brilliant quantitative mind combined with this deep qualitative, intuitive approach to modeling that has made Emanuel Derman such an important force in our industry. Right now, Emanuel Derman is head of risk at Prisma Capital Management and professor at Columbia University. He's the author of My Life as a Quant, one of Business Week's top 10 books of the year. His latest book is Models Behaving Badly, Why Confusing Illusion with Reality Can Lead to Disasters on Wall Street and in Life. He spent time in the 1980s at Bell Laboratories. From 1985 to 2002, he worked on Wall Street, running quantitative strategies, research groups in fixed income equities and risk management. And he was appointed a managing director at Goldman Sachs in 1997. The financial models he developed there, the Black-Derman-Choi interest rate model, and the Derman County Local Volatility Model, a widely used industry. So please join me in welcoming Emanuel Derman.
Thank you for a very nice introduction. You get to write it down. This is a talk. I work actually part-time only at a fund of funds called Prisoner Capital Partners, who's always over there. And everybody in the whole world has been interested in hedging tail risk to the point where I don't know, I've seen articles lately that say tail risk isn't a tail risk anymore because everybody's so occupied with it. It's not really an unexpected event. There was an article I saw by, I forget his name now, Chris, somebody from a hedge fund on the West Coast, who said that a real black swan is not when your parachute doesn't open, but when you're killed playing golf on a course by somebody whose parachute didn't open. So, I forget his name. It's Chris. Will come to me. Volatility hedge fund on the West Coast. Okay, so this is last summer. We spent a lot of time where I worked at Prismo, myself and a student who worked there, trying to look at polls. Actually, we haven't implemented this yet. And I don't think we're going to, mostly because we're a fund of funds and people don't want to do their own ways. And don't want to do funds that ensure you. So let me describe this. It's kind of data mining. I've never really done data mining before, but it is in that category. But nevertheless, I think the results are kind of interesting. But past performance is no predictor of future behavior, whatever it is. Okay, so this is just a brief introduction for people who aren't in fund of funds. That David probably knows a lot about this. That risk management is very different. I used to be in risk management, always either on the trading desk or in firm-wide risk management. And being an investment bank is very different from being in a fund of funds, which is the first thing I'm going to talk about. And then this is the outline. The second part is really how do you, well, I'll come to it. Basically, how do you hedge? How do you hedge a portfolio of hedge funds against so-called tail risk, and what is tail risk, etc. So let me move on. This is just background, as I said. When I first came to work at Prismo, I really was used to being at a derivatives. Is there a? There's a no, there. So if you work at a derivatives desk, you've really got complete position transparency. You know exactly what the desk owns. You know what models you're using to value it and to hedge it, and you can run it intraday using a model, and you can do everything bottom up. You know, deltas, gammas, risks, scenario analysis, stress test, whatever it is. I worked for a couple of years in firm-wide risk at Goldman from 2000 to 2002, and it was very different. You couldn't work bottom up. I think maybe they're getting closer to doing that these days, but then you really couldn't. You didn't in one central position, in one central location. You couldn't have all the positions of the firm. They were distributed. You really got more was individual risk reports from individual desks, and you had to aggregate them top down. And fund of funds is sort of more like that, even worse in a way, because these days you do often get positions from fund of funds, from individual hedge funds, but typically not from all of them. Sometimes every month, sometimes every week. It's getting better. So in the end, you get values from custodians daily, weekly, or monthly. You don't really know, and even if you know positions, you don't know enough about them to actually value them yourself. So we have to do risk management in a very top-down and bottom-up eclectic sort of way, as David said. You know, combining exposures that you get from hedge funds when they give you their exposures to different market sectors, stress tests and regressions of their NAV to kind of do style analysis, nonlinear regressions, looking at their betas and different up and down market moves, and trying to understand their optionality. But you don't get anything like what you'd like for. Plus, they can do whatever they like in a given month, so very hard to understand how to hedge or manage risk. Okay, so well, the point I want to make about tail risk, which is sort of what became apparent, was really apparent before, when we started looking at it, is that really tail risk isn't a single thing. Everybody uses one word for it, but there are many different things that have hurt you. So this is a graph from HFRI data of the fund of funds composite index, and $100 starting in early 1990 and going through almost 2012. And you can see there are blips over there, sort of a blip over there, big blip, which we're still suffering the aftermath of over here, and a little one over there. All of these are sort of, I suppose, in some sense, tail risk events, but they're all really come from completely different things. This was the collapse of the CMO market in the early 90s and Kidder Peabody, and the whole fixed income crisis that went on at that time. This is Russian default, LTCM, much bigger effect, but kind of short-lived. This is the internet bubble for a long time, and 9/11, and this is the GFC, Great Financial Crisis, still ongoing, which is sort of the sharpest. I don't have the 87 crash here, and this is this last one in early 2010. There is flash crash, British Petroleum in the Gulf, and Greek riots. So all of these are totally different things, really, and yet when you talk about tail risk, you want to be insured against all of these, and it's not quite obvious what you ought to insure yourself against. Where I work, we're more interested in, as I say, not the S&P, but there's similar graphs for the S&P, but really just looking at how you protect yourself against exposure to hedge funds. And one of the things you notice that what is common to all of these strategies is that they all, well, two things. One, this is the same growth of $100 but now it's plotted against this blue line is the VIX. And the one thing that seems to happen in all of these strategies is, almost all, is a big bump in implied volatility. So you see that over here. You see a really large one in the Great Financial Crisis. You see another one around the flash crash. And so it looks like all of these hedge fund strategies are in some sense short volatility or short volatility of volatility. And that volatility looks a priori like one of the ways you could try to insure yourself by being long volatility against fund of funds or individual hedge funds disasters. And I want to talk a little bit about why that is. Actually, what I said on the last graph was hedge funds often trade via models, whether they're formal or informal models. And I kind of like to argue, related to what I spoke a bit about this morning, is that most funds, whether they know it or not, or whether they intend to be or not, are in some sense short volatility. There may be one category that isn't. And I want to sort of outline the rough qualitative reasons why. So first of all, in almost any crisis, volatility, and I really mean mostly equity volatility, tends to go up, which I showed before, no matter what the source of the crisis is, whether it's fixed income or equity or credit. It's often equity volatility goes up. And all the individual hedge funds tend to be short volatility in one way or another because, first of all, if you look under normal market conditions, if you look at long short funds, they mostly have a net positive beta to equities. And in a crisis, equity markets fall because they have positive beta and volatility rises. So in some sense, though, depending on how net long they are, they in that sense proportionally short volatility. In the sense that market down, pretty much all the behavior of the world in general in equities, with small exceptions, is index down, volatility up. Indices crash fast and rise slowly. Of course, it doesn't work the other way. You can have volatility going up without the index doing anything. And so that's not a good trading strategy, but index down, volatility up sort of is. All of the models that hedge funds use, in the end, they only work for a limited range of scenarios that you can imagine. This is sort of related to what I was talking about this morning when we were there. And I think it's true to say that almost any model you make, when the world moves sharply out of the ranges that you built the model to handle, or that your model handles irrespective of how you built it, that is when volatility kicks in, or when volatility gets large, the model will likely be wrong. You may sometimes be right, but more likely you're going to lose money, or things are going to behave strangely when the world goes into a new regime. And I've got a couple of examples here. So if you look at event-driven strategies in M&A or in risk arbitrage or in distress, they often tend to take, say, risk-off positions that short one company long the other based on some takeover. But if you get a big equity crisis and all stock prices tend to drop, a lot of the convergence is going to fail to happen and people will get through the deal. So in a sense, you're short volatility. If you look at relative value strategies like convertible arbitrage, you think you're long volatility. If you own convertible bonds, but when the equity market drops a lot, credit spreads tend to widen, and so you're actually short, and converts decline in value anyway, so you're kind of implicitly or secretly short volatility a lot of the time. The one counterexample that I know of is macro CTA funds that trade momentum successfully, and they're sort of, as a bunch of people wrote 5 or maybe more 8 or 9 years ago, are synthetically long a straddle if they ride the market up and they ride the market down successfully if they're trend followers. And so they usually long volatility, although even at very high volatility, even there people can become irrational. But macro CDA funds do tend to be, I'm going to show some more about this as a hedge, they do tend to be long volatility, although long volatility over the long run, not long volatility over the short run. It's not like owning options. It's just if the market goes up steadily, they will go up, and vice versa. So now I want to talk about tail risk protection. I said there's really no generic tail risk. This is the same graph that I showed before with the ranging from fixed income, credit, and LTCM, internet bubble, great financial crisis, which started with models and mortgages and ended up with economics, and Greek riots, all kind of pretty much different things going on. What happens in crises? In all of these crises, especially the recent ones, you get a flight to simplicity. So nobody wants to own complicated structured products anymore. Nobody wants to own liquidity. So you get a flight to simplicity. I kind of remember actually working at Salomon Brothers on the mortgage desk in 1989 when there was a mini post-87 crash. And markets weren't as well connected in those days. And the way everybody knew that something funny was happening in equities was that 1 month treasury rates suddenly dropped like crazy, and it took a few minutes before people realized that everybody was getting out of equities because there was a big mini equity crash, and buying short-term treasuries with their money. So you get people flowing, whoops, sorry. You get people going for cash, treasuries, gold, not a very good hedge it's going to turn out to be. They avoid illiquidity, they avoid credit risk. You get a concomitant increase in volatility, both real volatility if the market crashes, and even more implied volatility, which is really the more important one in terms of hedging. You get increasing correlation across securities and across asset classes in really big crises. And as I said before, a lot of the models hedge funds use are going to come a cropper. So we sort of did a study of how you might look for some downside protection. And our preference where I work is really more to do the first, which is we're a fund of funds, and so ideally we'd like to, we don't do overlays, we don't buy our own futures or buy options, at least until now. And so the preferred method is really to invest in hedge funds that provide downside risk protection. And I'm going to talk a little bit about that. Overlays I mentioned, and I'm going to mention again, treasuries or gold, oil, commodities. And the ones I'm going to concentrate most on are volatility overlays. S&P puts, black swan funds, varying swap portfolios with different return frequencies. All of these things might give you some exposure to wanting to be long volatility, long positions in correlation, dispersion, and avoidance of illiquidity. If you see what happened to LCTM, who were basically long a whole bunch of illiquid things that were trading cheap, that's kind of difficult to dodge when you're in the hedge fund world. So this is what we first try to do is set up a metric for quantitatively measuring the benefit and the cost and the protection provided by a bunch of these different strategies. And this is the metric that we came up with. This is all hypothetical. So the black line is a hypothetical HFRI, or our fund of funds just made up. So, and these are all the returns, monthly returns ranked from lowest to highest. So these are the most negative monthly returns. These are the most positive ones, irrespective of time order. And the red line is meant to be what your returns would look like if you had, or had you had, protection, say, for argument's sake, you're at a 5% level. So instead of owning 100% of your fund of funds, you had 95% of your fund of funds and 5% of some overlay or some hedge fund or some tail protection strategy. You'd expect to see a gain you'd expect to see a gain, meaning you protected against the really bad results, and hopefully some gain on the positive side too, but at least not too much of a loss. And so this graph on the right is, it's completely hypothetical. I made up these points, but I'm going to show you real ones later. This graph on the right is the difference between the red graph and the black graph on the left. So this is the protection from most negative to most positive. You'd like to see a lot of protection on the tail. When you're unprotected really badly, you'd like the 5% position that you added to give you a lot of excess return to protect you on the tail. And then what you'd like over here is not to lose too much. If you could really, yeah, not to simply go straight down as you would with a long short, but with a straight short position. So what you like in short is a large slope on the left-hand side and some convexity, meaning that you don't lose on the right-hand side either, something like a put payoff. And we've got three. How long have I still got? Sorry? Oh, okay, that's good. So what you like is, so we have three numbers that we look at. One is the benefit of the tail strategy. And I'm always going to be imagining I spend 5% of my money, of my NAV on a tail strategy. You'd like, okay, the benefit is the average number of basis points you save monthly for negative returns, meaning to the left over here. The penalty is the average number of basis points you give up on the positive side when you would have made money, and now it's, your tail hedge may actually be harming you. And the potential cost is the average of both of those. So how much money do you make or lose over the whole scenario? I'm mostly looking historically. So these are some examples. And this is really for the HFRI for the period that I mentioned. So these are HFRI fund of funds returns ordered from most negative to most positive. And you can see the way they go. And now, maybe I can see it over there, okay. This is what happens. The first thing you try is really just buying a short bias fund, and all of these are HFRI indices that are listed over here. And you see you get protection on the left-hand side, but you give up everything on the right-hand side because you're basically net short. So you get tail protection, but you give up just as much on the positive side. And from where I'm standing, I can't read the numbers very clearly, but it's clear that this isn't really we do own short funds, but they protect you on the tail side, but you've got a matching cost pretty much on the upside. This is kind of linear. This is macro, and I mentioned macro is actually the one hedge fund strategy that we found that really does provide you protection. If you look at this, it gives you protection on the downside, but it doesn't lose you too much on the upside. It looks pretty much like a put. So it kind of gives you a fair amount of, it kind of has the right profile, but when you actually look at the magnitudes over here, I'm having a hard time reading this from there, but you'll find you don't really get a lot of bang for your buck. If you put 5% of your portfolio in macro, you get protection, but it's nothing compared to what you lose, or very negligible compared to what you lose on the 95% side. Gold is really surprising. Everybody, myself too, meant that gold would be good. And the same applies to commodities and oil, but it's actually very chancy. There are periods when gold behaves really well, and there are periods when gold behaves, even when the market's going down, when gold really doesn't go up. And it actually has a very, very unpleasant profile and totally unreliable in terms of a tail hedge generically. So commodities, I don't have it here, but this is all in a paper on the Prisma website, actually, if you want to see the detailed graphs for every single hedge fund strategy through mid-2011. But so the thing that we finally looked at was really, what comes to mind first is trying to buy protection by being long volatility. And, so this is spending roughly 5% a year, so putting 0.5% per month in at the money 1 month S&P puts. And you can see it has the right kind of negative slope that you want in tail events. It levels off like a hockey stick on the right side, but I have to get close enough to read this now. But okay.
So your benefit is like 16 basis points. Your penalty is 24 basis points because you basically lose on all the positive side by buying puts all the time. And the net cost is 10 basis points or 11 basis points. This is all historical, of course, but 10 or 11 basis points per month. So kind of got the right profile. And actually, you get a fair amount of bang for your buck in the sense that when this goes down to -6%, this goes up to about 2 or 3%. So actually not bad for a 5% protection, but you give up a lot on the upside. This, actually, the student I was working with, he started looking at this more carefully, and this really gets into the realm of data mining. But what we kind of noticed was that, at least since 1990, whenever the VIX was in the third quartile from the bottom, or second quartile from the top. Okay, 5 minutes, I'll be done before then. Okay. This is what you get if you put 2.5% in at-the-money 1-month S&P puts, but not systematically every month, but only when the VIX is in the third quartile from the bottom, which roughly corresponds, it's actually a rolling third quartile, but it roughly corresponds to between 20 and 25 vol points, 2026. So if whenever the VIX went into above 20 or below 26 in the previous month, coming down or going up, if you bought 2.5% of your portfolio in at-the-money 1-month puts, this is the kind of protection that you get. You get pretty good protection on the downside, and almost 1-for-1. You see this goes to -4%. This is about +2%. Maybe half the portfolio is protected. This is a regression line. Almost never lose money on the big moves, and you actually don't lose anything on the positive side. So that you get 71 basis points per month of protection when you need it, and it actually doesn't cost you anything. Can't claim this is going to happen in the future, but it happened pretty consistently in the whole period we looked at. This shows the background to this, which is what the S&P returns look like for various VIX quartiles. And this is when the S&P, when the VIX was in the lowest quartile, meaning like probably 14 or 15, and there's not much downside in the previous month, not much downside move on the S&P. Second quartile, you see some tail. Third quartile, you see a really long tail. If the VIX was roughly between 20 and 26, but really, to do it honestly, we do rolling quartile, looking at all the past. You see you get a lot of negative tail, and then when the VIX is already very high, it's kind of a little too late to put on protection. So third quartile looks like the best region. That's what the other one showed. And this is just unfinished. This is just a summary of all the different statistics summarized in the paper of all the strategies, and you can see this has got the benefit, the penalty, and the cost. Beta is the slope to the HFRI, and gamma is the curvature, how much optionality you have to protect you when things go up rather than down. And you see hedge funds basically almost don't do you any good, don't give you a lot of protection, often give you a lot of cost. And the only one that really works is macro, but it gives you very little protection. And gold is very erratic. Credit only works in credit crises, doesn't work in the other crises. And to summarize, my time is up, buying, the only thing that seems to have worked historically is buying S&P puts when the VIX was excited, but not too excited. Okay, I'm going to stop over there, thanks.
So I think we have time for a few questions.
You mentioned that your student got involved in doing data mining on this. Could you say a little bit more about what techniques he was using and the results?
About what?
The techniques that he was using and the results that he got out of that.
Yeah, well, these are the VIX stuff, are the results. It was basically, we came up together with this metric for measuring the how much protection you were getting and how much curvature you were getting optionality. And then we simply took HFRI, composite or macro commodity, subcategories, and used all of their historical results to and took a 5%, except for the options. Generally, we took a 5% allocation, 95% allocation to the HFRI, added 5% of whatever strategy we were trying, looked at the monthly returns, and tried to see what that profile looks like. With options, it was tough, and we actually had to go back and dig up S&P option prices and VIX data and roll them every month as best we could.
Thank you.
you focused on the S&P 500 VIX. Can you talk about other securities or other tail risk strategies that you consider?
I hope I just did. Meaning I described a whole lot of them.
Well, European,
Oh,
geographic,
other
European,
equity.
Japanese.
Didn't do it. Should, but didn't. We pretty much stuck to the S&P and the VIX. Having lots of data about the VIX. There are analogous volatility indices and other.
It's just the reason I bring this up is because the last couple of crises have been U.S. centric, and with European crises and potentially Asian crises on the horizon, is all this focus on the VIX the right way of protecting yourself?
That's a fair question. I don't know, although I was going to say the whole world's kind of connected these days. But you're right, you could get something happening over there that doesn't affect us, although it doesn't seem like that these days.
Did you happen to look at the VIX adjustment? Did you happen to look at the investigate how the VIX adjusted, the VIX influenced hedge, how robust it was through time? For instance, prior to September of 2008, the quartiles would be significantly different in VIX.
This, I have to look there, but this went back to at least 2000, the VIX study. Half answering him and half answering, what we have looked at where I worked in the last year is looking at a lot of funds that trade VIX futures as a form of tail risk protection. But they're kind of tricky because what a lot of them do is you really want to be long volatility in a crisis, but then you lose money if you keep going long volatility. And again, the VIX futures has a weird term structure, so that if you keep buying VIX futures and you have to roll them because they expire, the slope of the futures curve makes you lose money the whole time. So as a result, what all of these guys do is something I don't feel safe with, is they actually go short volatility to offset the fact that the VIX roll is losing their money. And then what they do is, if they get a warning, like I have this warning for the VIX, what they do is when they think something bad is about to happen, they take off their short position. So they've got the danger that if something bad happens too quickly, they're actually going to lose money on their tail hedge, which is kind of scary. But there are there are a bunch of people. Velocity shares is one of them, and there are a bunch of I think Man Group, GLG, have strategies that certain velocity shares one that are basically short volatility and take off the short position when they think the crisis is coming. But kind of scary for me. I mean, you don't want to, if you're a fund, you don't want to put on a tail hedge that loses you money when something bad happens. It's kind of offensive. But yeah, there are a lot of, there are at least JP Morgan, I think there are a bunch of places that are all selling tail hedge products now.
And this will be the last question.
So if I look at tail risk events, they all seem to have different origins. In other words, not all tail risk is created equal. So do you think, and obviously if that's the case, then they would require different hedging techniques depending on their origin. So do you think more research on what causes different types of creating like a classification tail risk event could help?
Yeah, I'm a little, I mean, I gotta say, the more I look at it, the more I'm skeptical. One part of me is skeptical about having a generic hedge against anything because so many different things have happened. But I don't know, just my opinion, I still think being long equity volatility in some way is the best thing, and that almost anything seems to hurt that. So I don't know how to do better than that. If you could just buy the VIX, and we actually, before we looked at traded VIX strategies, if you just pretend the VIX is something you can buy and you do that, you get phenomenal results. The trouble is you can't buy the VIX, and so you have to do it through S&P puts or through VIX futures, which have all those problems. But I'm getting long-winded, but I still feel like being long equity index volatility is the thing that comes closest to insuring you against crises.
Great, thank you.
Thanks.